Good afternoon, everyone. Welcome to Phillip Roundtable. Sell in May and go away is a traditional investment saying that suggests potential market weakness during the month of May. In fact, people often say May is not a good month for the stock market, right? When we look at the Malaysian market represented by KLCI, historical data supports this argument with an average return of negative 1.35% over the past 10 years and negative 0.68% over the past 20 years. In the last decade, only 3 years had positive returns, while 8 out of past 20 years were positive. Across the globe, if we look at the US market, historically, May is actually a good month, right? With 9 out of the 10 years show positive returns. So, and this year we see different market behaviors whereby the US market, Euro market, or even Asia Pac and back home, the Malaysia market have seen good performance thus far for the month of May. Today, we are honored to have two speakers with us. We have Noor Aini Ali Kasim, CFA, the Director of AIA Pension and Asset Management, and Pamela Yao, CFA, the Managing Director of Client Portfolio Manager, Asian Equities, Manulife Investment Management. Allow me to introduce Noor Aini Ali Kasim. She joined as Director of APAN Fund Management effective 29 April 2024. Aini brings over 15 years of experience spanning both the financial and regulatory sectors in areas like portfolio management, strategic investment, equities, fixed income, research, and data analysis. During her time at Bank Negara Malaysia, she managed diverse equity portfolios across multiple sectors and countries. Aini's strategic acumen and commitment to ESG integration led to her involvement in national projects and initiatives, underscoring her dedication to sustainable investment practices. Aini holds a Bachelor of Arts in Economic and Social Studies from the University of Manchester. Ms. Pamela Yao, CFA, based in Hong Kong. She's a managing director and is responsible for the coverage in Asia equities, with primary coverage on China-Hong Kong equity strategies. She works closely with the China-Hong Kong equity investment teams and is the primary resource for communicating the key features and attributes of the company's Asian equity strategies to existing clients, prospects, and consultants globally. Pamela has over 20 years of experience with a background in equity research. Before joining Manulife Investment Management, she was Director in Equity Advisory at HSBC Private Bank. Prior to this, she was an investment counselor at Citi Private Bank and equity specialist at Merrill Lynch Wealth Management, Bank Julius Baer, based in Hong Kong. Earlier in her career, Pamela worked as a consultant with Deloitte Consulting in Toronto and as an equity research associate with RBC Capital Markets in New York City, United States. Pamela holds a Bachelor of Applied Science in Systems Design Engineering from the University of Waterloo, Canada, and an MBA from the University of Toronto, Canada. She's a CFA chartered holder. Let's start with the first question. Just now we mentioned about sell in May and go away. May is not often a good month for the stock market, right? But perhaps we can start with Aini, right? What explains the behavior of the market, why there's weakness in May, and why probably this year around in May, we see different market behavior whereby we managed to witness some positive performance across the global markets that we monitor. Over to you, Aini.
Thank you so much, Kim, and thank you so much for very comprehensive introduction. Really honored to be here, and hi to Pamela, my peer. You are right to mention that in general, in the past, we've seen that there's a lot of anxious or anxiety surrounding selling May and go away, and very much connected to summertime when traders go away and then TP, right? But that may not necessarily hold true. In fact, for Malaysia market, if you see last year, we managed to record slightly over 1% for the month of May until October, and we've seen a very strong performance year to date, and we continue to believe that the momentum will continue to be positive in the next few months. And now I would say that this pattern, while in the past, like you highlighted, it has very strong correlation, but it may not necessarily be true. And I think from Malaysian market in particular, largely driven by a few reasons. One is the fact that we've seen very strong economic conditions. So what we've seen overall is really continued momentum in terms of positive macroeconomic data. And we've seen that in quarter one, and we continue to see high frequency data have been very favorable. For example, our GDP that was just announced a couple of weeks ago, I think GDP in quarter one for Malaysia slightly over 4%. Above expectations of 3.9%. And Bank Negara also during their May briefing, they did mention that in terms of forward-looking indicators, it continues to point to growth for Malaysian economy, right? And the central banks expect consumer spending to improve, and this is supported by high income levels, sound balance sheet, as well as support from governments. Obviously, you all are very, very aware what's going on in the US. We've seen very solid improvement when it comes to economic indicators, particularly GDP. And secondly, I would say monetary policy. Central banks really hold a very, or I would say play a very significant role. Fed Reserve in the US and Bank Negara maintains, at least for year to date, maintains accommodative monetary policies. This can provide liquidity and support for risky asset, for stocks asset. With all this, right? With the fact that I mentioned that macroeconomic data has been very, very positive, the rate cut expectation actually been brought down from 6 last year, December last year, to just 1 this year, right? And I think the third one is really how the positive macroeconomic data translate to potentially earnings upgrade, positive earning upgrades. So all this together kind of provide support that this year may differ slightly from what you've highlighted earlier. And I don't want to take up a lot of time explaining in details all these key things. I'm sure we can discuss a bit more. Over to you, Kim. I hope that I answered your question.
Yep, thank you so much. Probably Pamela can take the question, since when the fund managers or even the clients are actually saying selling in May and go away, and probably this time around we didn't manage to witness that kind of weakness in the market, given just how Aini actually mentioned, Malaysian market has been supported by strong fundamentals, and in the US we see some potential earnings upgrades as after the result seasons. So does that suggest that probably investors should actually stay invested, ignore the short-term volatilities, and ensure that the so-called long-term participation in the equities or probably in the market, right, is there for a longer time? Is that so?
Sure. Let me address this question. Yeah, if you in fact looked at Asia and particularly China and Hong Kong markets, year to date until last Friday, May, it actually market has been quite strong. For Hong Kong China market, Hang Seng Index is up more than 10%. MSCI China also up more than 10% year to date. So it's driven by a couple factors. Number one, very strong supportive policy from the Chinese government on different areas, not only in stabilizing the Asian market back in January, but also throughout the course of the last 5 months, there have been a lot of supportive policies rolling out. Later on, we'll discuss more in details. And also, China has been keeping the monetary rates quite low, unlike the US. That also helped the economy to basically to recover further. We think investors should look at China at this juncture, not to sell in May, on the back of these policies and favorable supportive earnings fundamentals.
Yep, thank you for the answer. And probably just want to ask the question, since just now we were on rate cut, probably interest rate decisions by the Fed. Just now, Aini mentioned that there was 6 rate cuts, expectation of 6 rate cuts earlier this year, and now the expectation had actually shifted to, in fact, 1 to 2 rate cuts beginning in September. So, Aini, in your opinion or in AIA's PAM, opinion, what are the chances that we may end up not having any rate cut this year?
Right. Tough question. At the end of the day, I think rate movement is really, really data dependent. Fed in particular is very data dependent. Like I mentioned, December last year, rate cut expectations about 6. Obviously, that changed over the span of just 5 months, and that's largely because of the high frequency data that's coming from US, right? But based on our projection, our in-house view is largely in line with market expectation. Possibly we'll see about 1 rate cut, but the timing may be delayed to Q4 this year, right? The likelihood of no rate cuts this year is again very much depends on several factors. So Fed, they have dual mandate, right? They have inflation mandate as well as employment. So these are the data that been closely monitoring by the market participants as well as Fed officials. So they will continue to monitor the development of inflation data, employment as well as the overall economic growth. So if inflation remains above the Fed's target of 2%, or if the labor market remains tight, means really, really good, translate to high wage. So the Fed may decide to maintain or even possibly raise rates to prevent the economic from overheating, right? So inflation is the mandate. Now, unemployment rate has kind of like hovered between 3.7 to 3.9% since August 2023. I would say that this is a really good number. And the April number you've seen slightly below 4%. So what it means is really a stable labor market. Employment has continued to grow in the US, although it's kind of like slower pace compared for the last few years. So that would translate to concern about what could be the inflation or wages growth, right? Now, again, like I said, that is the first one, the labor market. Inflation-wise has been a significant concern, but we've seen signs of stabilization. So the Fed has been monitoring these two trends closely. I think they have a very tough, they're in difficult position trying to balance the efforts between controlling inflation without significantly bringing down the employment growth. So I think all this come together will potentially, Fed will potentially deliver the one rate cut that we are currently expecting, but the timing is it could be delayed towards the end of the year.
All right. Thank you so much. Pamela, what are your thoughts on the Fed's interest rate decision? Do you think we are going to see rate cut by end of this year, or probably we are not seeing any rate cut this year?
Our macro strategist view on rate cuts, US rate cuts this year is we still believe there might be 1 rate cut potentially in September, but it depends on a couple factors. Number one, like Annie said, the job situation in the US. If you look at payroll numbers, it has been quite strong. So it's also affected by the second factor, which is inflation, because with the ongoing war that's taking place, inflation has been moderating, but it also depends on the trend going into the second half of this year. Yeah, and then also I think in terms of the consumption spending and some of the data that we are looking at, it really depends on some of these factors, how it turned out in the second half of this year in the US.
All right. So probably a follow-up question to Pamela. Because of the expectation of the rate cut has been delayed. Earlier this year, we talked about 6 rate cut. Now we talk about 1 rate cut, things like that. There was an argument that rate cut could benefit emerging markets and currencies, but since that expectation has been delayed, does the thesis still hold now?
In our view, rates is one of the equation, but if you look at markets and also companies, performance overall year to date, Asia actually has been doing quite well. Just talking a bit broadly about Asia, we have seen very good earnings recovery in some of the sectors in China, for instance, in industrials, in communication services. And these are driven by basically fundamental improvement of companies. So for instance, give an example, basically some of these companies are seeing better revenue growth by going overseas and capturing overseas market share, and also cost cutting and savings. So we have seen some fundamental earnings drive, which drives the stock re-rating and the sector re-rating. So we don't think it's just purely a rate factor. On the other hand, you've seen, for instance, Taiwan has been outperforming in the Asia Pac region. The year-to-date market is up about 15%, and it's driven by a couple of things. Number one, the AI proliferation. Everyone talks about AI. It's not just a buzzword. It actually benefits the entire supply chain. So in a way, Taiwan is a key beneficiary of AI because it has a lot of hardware component and supply chain located there, serving global customers. So these are fundamental reasons why some of these markets are up and strong this year. And over to, for instance, country like Korea, we have also seen good earnings recovery. We have seen global memory cycle bottoming out and global semiconductor cycle also bottoming out. So early recovery drives some of these sector gains, which benefit the overall market in Korea. And also, if you look at Asia Pac, even though high interest rate actually do dampen the costs in a way, but if you see some of the companies are still delivering very good earnings. So net, I think it's not just a rate factor, but it's a holistic approach when we look at markets here.
All right, thank you, Pamela. And since we're on Asia equities, Aini, what are your thoughts on Asia? Recently, we see Japan markets, Korea markets, and Taiwan markets, they're actually doing very well in 2023, and the gains are actually extended in 2024, while other parts of Asia, like China, is catching up. India, the valuation is high, but probably the earnings growth may sustain the momentum. What are your thoughts on Asia?
Yeah, sure, Kim. From our perspective, really, when we invest, we look at long-term perspective because we invest for retirement funds. And to answer your question, we do think that Asia provides a very unique investment opportunities, particularly from the diversification benefit. Because when you look at Asian countries, right, each of the countries actually going through a different economic cycles and come together, they provide a very unique value proposition. Asia also is considered one of the fastest growth region, and this is supported by emerging new drivers. So last time, maybe 20 years ago, when you talk about Asia, you always think about low-cost production countries, for example. But we've gone through transformations. We benefit from digitalization, supply chain realignment, technological innovation, as well as domestic consumption. And talking about domestic consumption, there's a very good research by McKinsey that predicts that Asian consumption will represent more than 50% of the world's consumption. And just imagine that. So when you ask me about Asia, if you forget Asia or you put aside Asia, you're basically missing 50% of the story when you're investing, right? And then there's a lot of research about expansion of top companies in the world, whereby more than 70% of C-suites and 100 of top MNCs around the world actually prefer Asia for expansions. And the very reason is really the consumption. So you also mentioned about various countries just now. You talk about India. Completely agree with you that India is very promising. Growth expectation about 8%, a very eye-catching number. And I believe that what India is going through now is basically what China gone through 10 years ago. So they do have skill advantage. And fun fact about India, they have the third largest youth population and third largest scientists and technicians in the world. And then Pamela touched on about semiconductor from Korea and Taiwan. And these countries remain the two key export hubs when it comes to AI server supply chain, right, and high-end chip packaging. Other Asian countries, for example, Malaysia, Indonesia, Vietnam, these are the countries that will benefit from China plus one policies, right? They will benefit from the tech supply manufacturing relocation. For example, Apple announced more than 75 manufacturing hubs for their iPad in Vietnam. So these are the countries that could benefit from the supply chain relocation. Malaysia, for example, as we've seen political stability and policy continuity, we've seen improvement in FDI, particularly in our E&E sector. And I think put together all this, valuation in Asia is still attractive. So it was rather overlooked for the last few years, and given the strength of macroeconomic fundamental pickup in growth consumption, we do believe that Asia provides a very promising from long-term perspective.
All right, thank you, Aini. So to sum up, we actually talk about the demographics of Asia economies. We also talk about the growth and also earnings visibility of the Asian equities. And in fact, if we zoom into IMF's economic outlook that was released in April, right, global growth is expected to see about 3.2% this year and next year. But the bright spot could be the emerging and developing Asia, which is expected to clock in about 5% growth this year, mainly led by China and India. Probably we just zoom into China. The question, of course, is dedicated to you, Pamela. After a prolonged stretch of lackluster performance in the Chinese equities since 2021, if not 2022, there was a significant turnaround starting in February, right? The year-to-date gains of Hang Seng, like you mentioned earlier, it's about 10%, right? MSCI China also clocking about 10% return year-to-date, right? So when we speak to selected asset managers managing Asia-Pac mandates, they are now shifting their underweight position on China to at least neutral. What are your thoughts on China, Pamela?
Thank you. Yeah, so on China, in fact, the transformation year to date has been quite a lot of things going on, and in a way positive for the economy, positive for companies. Let me try to explain this into a couple parts so it's easier for investor to understand. So first off, on the policy front, it has been very supportive. Back in January, China actually has been rolling out concrete measures to stabilize the financial market. If you recall, Asia market has been quite volatile in January because of quantitative funds, the trading and the selling pressure. So with some of the transformative change, CSRC, they replaced the new head, and also they lay out details in terms of how to regulate the market, in terms of how to tighten the regulations for IPOs, and also encourage companies to do more share buyback and also to improve the ROEs. All these actually help incentivize Asia companies to basically really deliver shareholder values. So you can see throughout the course of the year to date right now, a lot of companies have been actively participating in share buybacks and also increased dividend payout as well. So that's number one positive, definitely good for the market. And also, since February until May, China has been rolling out significant policies in different areas. So first off, in the industrial sector, they have been announcing equipment upgrades that actually until 2027. They basically qualified 10 types of equipments included basically to encourage old equipments to be upgraded, including facilities equipment, including construction equipment, equipment, including old building equipments. So that actually is a good incentive because some of these outdated, not renewable energy friendly equipment, it will be phased out and being replaced. So we believe this might boost a replacement demand down the road, which is good for the industrial sector. Not only that, you can see that China really strives for modernization of industrial systems. So what that means is that basically, along with advanced manufacturing, so China, strive for more automated system, manual processes replaced by robots. So all these are taking place, and we have slowly seen a lot of transformation in this area, which is very positive. On the other hand, for instance, on the consumption side, China also rolled out policies such as vehicle, basically giving us subsidies to replace old vehicle to new energy vehicles. You can see that year to date, China's penetration of new energy vehicle in tier 1 cities is about 40%. In the lower tier cities, is about 20 to 30%, which is a bit lower. But that means there's still a lot of room to grow in domestic China. And not only that, a lot of Chinese companies are now exporting their products overseas. So that gives them, a global exposure that also benefit the companies. And also, last but not least, for the property sector, basically, you can see over the news over the last 2 months, China has been rolling out a lot of measures. For instance, lower down payment ratios across tier 1 cities. So Guangzhou, Shanghai, just yesterday as well. And a lot of these we haven't seen last year. We have seen a lot of tier 2 relaxation, tier 2 cities relaxation, but tier 1 just also become very apparent this year. That means China is really doing its best to basically help improve and stabilize the property market. And that gives investors more visibility in terms of seeing what the government is doing here. But having that said, I think in terms of the effect, it will yet to be seen. So we have seen some pickup on secondary transactions already, but but some of these week-on-week numbers, we already seen some improvement. So the concerted effort actually drives all the good benefits for China, and we believe second half there may be more earnings upgrade.
All right, thank you, Pamela. So to sum up, well, we have seen the Chinese governments are taking more proactive steps to spur the economy and the confidence, right? We talk about the share buybacks to enhance shareholder returns. We also talk about the upgrades in the industrial sector that could benefit selected players. We also talk about consumption in terms of EV penetration is still at the low side. Probably there are some chances that we could see potential growth in this area. And finally, we also talk about property. Like Pamela mentioned earlier, some of the tier 1 cities like Guangzhou and Shanghai have actually reduced the requirement for down payment as well as the lending rates. So apart from all these factors, right, would we see the foreign investors or probably some passive flows like ETFs to continue to flow into the Hong Kong market because of as a result of the slew of the stimulus measures that we mentioned earlier?
If we look at some of the data flows, fund flows until end of April, we have seen notably southbound. We have seen substantial inflow from China, domestic through southbound. That's a positive. And also, if we look at foreign fund flows, we have seen less underweight on China. And there is also some inflow from foreign hedge funds starting February as well this year. So we do think that in terms of the view on China by different investors, in terms of the flows that we're seeing, is incrementally positive. And we do also see some flow into northbound as well, into the Asia market. Yeah.
All right, thank you, Pamela. Over to Aini. Do you share the similar view on China? Do you think China has more leg to go?
Yeah, again, from long-term perspective, like Pamela highlighted, we've seen a lot of kind of like turning a tides to some extent. Politburo, back in I think July last year, they've announced a lot of measures, right? Even in April, some measures are focusing on property market. So to some extent, we share the same view with Pamela that China may have found a bottom. Most of the negative views potentially being priced in. But of course, it's not going to be a smooth sailing. There are some structural changes that require the government to come in and intervene and kind of recalibrate, particularly on the ongoing trade tensions. I mean, you guys are all aware about Biden's announcement a couple of weeks ago on tariffs, right? So those things could pose a potential risk if these things escalate. So in terms of our strategy, given this macroeconomic backdrop, while we may turn slightly optimistic that China is turning around, we're a bit more focusing on domestic driven names that generally kind of like insulated from all these external noises, companies that could benefit from import substitution and localization and to be self-sufficient.
All right, thank you, Aini. So just a follow-up question to Aini. So for AIA PAM, right? The Asia Pac mandates that you guys are actually managing, looking at right now. Do you guys what are the top overweight regions that you guys are actually looking at? Is it Korea or Taiwan, India, or anything else? Aini, you're muted. Sorry.
Apologize for that. So while we are focusing from long-term perspective, we do want to be nimble. We are slowly increasing our exposure to China. Like I mentioned, the strategy is really from local perspective, that could benefit from flow away from those companies that could be affected because of these external noises, so to speak, right? In terms of potential growth, really, like I mentioned earlier, India eye-catching 8% growth. And we've seen that apart from scale advantage in India, the wage level is still undemanding. They have steady consumption growth, improving financial sector and a supportive credit cycle, as well as improvement in terms of policy support from the government. So that is one. Obviously, everyone talk about Korea and Taiwan, and I think this AI and digitalization is really changing the way we do things, we work. So these two countries continue to benefit from this significant shift in terms of how we move forward, the way we basically work and play going forward. And then some other ASEAN countries, particularly Indonesia, Thailand, that could benefit from this EV supply chain. Malaysia, for example, could benefit from this high interest in China in certain sectors. Like Malaysia, one thing that I can highlight is the healthcare sector, glove sectors that could benefit from the tariffs. So I would say it's not really a blanket strategy on which country to overweight, because you're very bottom up. So there are sectors that could benefit from this whole dynamic change. And the key is really to stay nimble and stop picking.
All right, thank you so much, Pamela. From an Asia Pac perspective, apart from China, what are the other regions that
So in terms of our Asia Pac, in terms of what we like, I think we have been, as I just mentioned, we like Taiwan on the back of Taiwan is really a key area for tech boom. It benefits from recovery from the global semiconductor recovery. Taiwan commands, in terms of the foundry, it commands about 50% of the value chain. and Taiwan is also a very very strong in some other areas, including tech components, including AI design. For instance, we do like some of these companies that are benefiting from US and European orders that on AI server demand. So these are some of the positives, and we have also heard a lot of good earnings guidance from various companies on this. Also, we do see a very strong Korea companies earnings growth. So this is also some area that we like, and we have seen memory sector really outperform, driven by recovery play as well. And our house view is also positive on ASEAN. Like Annie said, is a key beneficiary of China Plus One. But having that said, I think we do, for different countries, there's different dynamics, and we do see it as in terms of the relative strength. We also like India as well. But I think overall, but going back to China, in terms of what we favor in terms of the sector preference, definitely for our strategies, we do have overweights on areas such as communication services, on the back of China TMT earnings recovery. We do have overweights on IT. So we are very keen on some of the semiconductor supply chain domestically in China that's benefiting globally. And also we have overweight on industrials as well.
All right, we hear you, Pamela. So over to you, Aini. Let's talk about Malaysia, right? Malaysia market has seen some good uptrend since the beginning of the year. Now, year to date, as of yesterday, we are up by about 11%, right? Energy, property, construction, utilities have done well last year and this year to date. So, considering the robust year-to-date performance, do you think it's likely that KLCI or even the Malaysian market overall could maintain its upward trend? What are the catalysts?
Sure. So I think before I answer that, just to remind again, last year while we managed, FBM KLCI managed to post positive returns, on relative basis, we were among the bottom when it comes to stock performance, right? But you rightly pointed out that this year has been very strong, and we continue to see positive momentum. We believe that Malaysia is going through a positive change, so to speak, going forward. And this is largely driven by a few reasons. Basically, the headwinds that we've seen last year became tailwinds that for this year. So one thing in particular is earlier you mentioned about growth expectation by IMF. For Malaysia, by negara, IMF, MOF is expecting Malaysia to deliver growth between 4 to 5%. And we've seen high frequency data, for example, our exports data, kind of like turning a turn, really showing huge improvements across the board, be it petroleum, palm oil, and E&E sector. So that's number one. And second one is really important. I mean, we've gone through challenging times when it comes to political stability, but we've seen that second half of last year, and that just provide clarity, and that boosts investors' confidence and sentiment, right? And we've also seen kind of clarity and stability when it comes to fiscal reform from the current government. For example, under 12th National Plan, the plan from 2021 until 2025, it sets the foundation to kind of realize the spirit of Keluarga Malaysia, which hopefully will change the course of our national development for the next 5 years. And these strong fiscal reforms, to some extent, strengthen the country's balance sheet, right? And then we've also got some infra projects that are currently being executed, particularly in the construction and property sectors like MRT3, RTS. We've also got policies in the pipeline that positively affecting our FDI flows. And these few initiatives not only boost the FDI flows, but in the long term, medium to long term, will boost our GDP if it's being implemented successfully. So I'll just give you a couple of examples, right? So the first one is National Energy Transition Roadmap, our NATR. The plan is very comprehensive and it outlines our gradual increase in renewable energy shares. So our government targeting by 2025, roughly about over 30% and more than 40% by 2035, an impressive target of 70% by 2050. So if those things being successfully implemented, it will uplift our GDP value from 25 billion to over 200 billion. And this will generate more than 300,000 jobs in 2050. Now, second one, I think those who are listening probably from Johor, we were all aware about special economic zone. What's different? Really, we're getting support from the king to kind of encourage the greater use of land, transfer of people between these two countries, not just people, goods and services. So Sultan Ibrahim wants to produce a win-win outcome for both parties, tangible benefits for people and businesses. So one example that SEZ, the Special Economic Zone, that could be a game changer is really you know about RTS that currently being built. I think about 70% completion. Once completed in 2026, you know, Kim, I'm not sure whether you've traveled from Johor to Singapore before. You most likely take 2 hours to drive from Johor to Singapore. But with the completion of RTS, you will only take 6 minutes from Bukit Chagar to Woodlands in Singapore, right? So 2 hours versus 6 minutes. Imagine the improvement in terms of transfer of people, goods, as well as services, value-added jobs for both nations. So all these things in the pipelines kind of like boost the sentiments, GDP, as well as FDI. So we do believe that in the long term, Malaysia is going through a very positive catalyst shift, and with this continued improvement in fundamental political stability and clarity, as well as fiscal reform, we'll continue to see strong momentum in Malaysian market, Malaysian capital market.
All right. Thank you, Aini, for your comprehensive explanation on the Malaysia market. So basically, to sum up, the catalysts are actually among political stability, right? We also pointed out the positive economic growth, 4 to 5%. In fact, that was from 3.7% last year, so starting from low base last year. And finally, some of the key events are actually happening right now, including, basically the growth are actually policy driven to sum up. NETR, we mentioned about NETR, we also mentioned about Johor, Singapore Special Economic Zone, and that will also attract some of the FDIs, influx of FDIs coming into Malaysia, right? Finally, before we end the session today, we would like to invite AIA PAM as well as Manulife to share some of the products or top fund picks that you think will help investors in navigating the market. Over to you, Aini.
Sure, thank you. Really, I hope that the listeners, I mean, Kim, your team, understand that our sole aim in AIA, PRS and asset management companies really to get more and more people prepared for their retirement life, right? So we want people to retire with dignity and potentially have a richer retirement life. I mean, this is a widely known fact that more than 65% of Malaysians are not aware that they don't have enough to retire. And we are here to help. We want to help these people, right? So it is imperative to start early. So we do hope that whoever is listening, if you're confused, please reach out to us. To those listening, take charge of your financial well-being. The sooner you start, the better. And it's simple. We accept contribution as low as 100 ringgit. Now, when it comes to funds, it's very simple. We only have 6 funds, very much focused and specifically meet kind of focus to meet the risk return profile by age. So we have 3 core funds where we call it Grow for people below 45 years old, Moderate for people between 45 to 55 years old, and Conservative for people that are above 55 years old. And why do we bucket this fund as such? So that people understand the risk return profile and the allocation by equities versus fixed income, as well as the global exposure of these funds to meet your retirement needs, right? We also have those that require investment in Islamic funds. So we have two Islamic funds, which is moderate as well as global Islamic growth fund. And we have one newly launched fund. Kim, we talked about Asia in detail earlier. So we launched this fund to really give a platform for the nation to our investors to invest, to tap into Asia unique opportunities from long-term perspective. So some of our funds, in particular growth funds, Kim, has done really well with double-digit returns, and we have won awards. I can give the details. I mean, look up for these funds in our website. But one thing to highlight is really the fact that the fund's been doing well, and the fact that we've won awards, largely not only because our rigorous process, bottom-up stock picking. We also work very closely with our big investment team out of Singapore, out of Malaysia, and we do have partnership with global players like Schroders and Fidelity. I hope that answers your question, Kim.
All right, thank you. I need a very comprehensive range of PIS products offered. Over to you, Pamela. We'd like to share some of your top fund picks within Manulife Investment Management.
Sure. So within Greater China space, I would like to highlight two funds here today. The first one is Manulife Dragon Growth Strategy. So this is a strategy that focuses on Hong Kong China market, and basically is a growth at a reasonable price approach, investing in different areas of China. We use a barbell approach, meaning that on one hand, we do look at structural growth opportunities, as we mentioned just now during the conversation. And also, we also have invested in some of the thematic large cap SOE names that have dividend yields. So in terms of the strategy itself, we have three themes. So the first one is innovation. So we do our investment team based in Hong Kong. We do look rigorously in the Hong Kong China space. We have invested in areas such as related to AI, related to global smartphone recovery play, as well as some of the China internet companies that are registering very good growth that are penetrating overseas this year. On the second theme, consumption, we have also invested in various pockets in terms of, for instance, tourism. Tourism in China is recovering in a big way. This year, outbound travel is picking up substantially versus domestic tourism, which has already quite recovered last year. So we have invested along the supply chain, included areas such as online travel agencies names that benefit from earnings recovery. Not only that, we also look at sportswear. So this is one area that is registering good growth because global inventory has been basically cleared last year, and this year is registering for good growth along with the Olympics upcoming this year. So we do look from a very fundamental approach to identify the stocks and the investment suitable for investors. So that's on Dragon Growth Strategy. The second strategy I want to highlight to you is Manulife China Value Strategy. It's our Greater China Equity Strategy. So this one focused not only on China, Hong Kong, but also on Taiwan region. And the reason why we also look at Taiwan rigorously is that because, as mentioned, Taiwan actually has a lot of unique, interesting semiconductor names that are riding a global recovery. And also some interesting name in areas such as AI design, in areas such as foundry, in areas such as network switching. So these benefit from global AI market growth and also benefit from the supply chain market share gains. So for Taiwan, for the Hong Kong China piece within the Greater China Equity Strategy, we also look very rigorously at domestic consumption names in Hong Kong China. We have selective names in various areas, such as the ones I've mentioned just now. And year to date, both funds are doing very well, registering good growth, good returns for investors. Yeah.
All right. Thank you, Pamela, and thank you, Aini, for joining our Phillip Roundtable session. We are pleased to have our beloved business partners from Manulife Investment Management and AIA Pension Asset Management to be our guests today. Stay tuned for our next Phillip Roundtable. This update is brought to you by Phillip Capital, your partner in finance. Thank you so much, Pamela and Aini. Thank you.
Thank you, Kim. Thank you, Pamela.
Thank you.
Bye.